Welcome back in here, guys, to the short-term rental video series. And a quick video here, I'm going to talk about avoiding a few traps. So there are some things that you need to be aware of on short-term rental properties and really any rental properties that most of these apply to. But the first one is the 14-day personal use rule. So if you stay in a property for personal use more than 14 days in a year, you can't take the losses from it. So when you're getting this, when you're materially participating in year one and you're using your short-term rental on this loophole on this property, do not stay in it for personal use. Do not vacation in that property yourself for 14 days. Do not let your kids go vacation in it or your mom go vacation in it unless they're paying you fair market rent, right? So definitely watch that. You do not want to have that screw you up. You want to make sure you're avoiding that 14-day personal use rule. Now, again, all that it means is if you stay more than 14 days, you can't take the losses. So if it's year 2, 3, 4, and you're out of losses because you cost segged and you got all the losses, most of them in year one, now you have income. Well, waterfall effect, kind of ancillary benefit is if you stay over 14 days personal use in year 2, 3, 4, if you have income, doesn't really matter. You got to pick up the income. You're going to offset it with taxes from, or with losses from maybe property number 2. That doesn't get impacted. So, but no, in the year that you're taking the losses on the property, don't stay in it for personal use. Now you can stay in it for working days. So make sure the working days that you're there and that you're staying are not personal use days. Those are working days. Document that well, right? So if you're working on the property, if you're there to paint it, to do everything else, you work half your day on it, 4 hours of a working day, right? That's a business day, right? You were there to work on it. It's a working day. So that day is going to qualify as a non-personal use day. So don't put it on your 14 days personal use. That's actually going to help your short-term rental log for your hours worked. So any days that you're there that you're actually had to be there working on the property for over half the day, those are going to be non-personal use days. So again, just make sure, and if someone else is staying there, mom, kid, whoever it is that's related to you, anyone staying there, make sure they are paying your LLC, your short-term rental business, they are paying it fair market value for the nights they are staying, right? So there's all kinds of ways to get creative with that, but definitely make sure you do not stay in that property more than 14 days in the year when you're trying to take those losses. Trap number 2 is getting properties that have high land values. If you get into these properties where the land is very high cost, it is going to negate the benefits of your cost segregation study. It is going to not allow you to take a lot of bonus depreciation on this. So, I'm based in Missouri. A lot of our properties around here are 10 to 20% land value at most, but you get to California, Florida, some high-end vacation type areas, like land values can be 50% plus. So you go get a $500,000 property, you start to look at the market rate of land and it's $250,000, right? Well, now you've only got $250,000 of a building to cost segregate. Much different. You're at a much different point than that $500,000. So $400,000 if you might be in Missouri. So definitely make sure you keep track of those land values. Work with short-term rental professionals who know it. Work with accountants who can look at it. There are detailed ways. It's not just a number off the cuff. There are ways to figure out the land value. There are several different ways to derive it that are approved by the IRS. So you need to make sure you do that. And you probably know that before it so that you have those kind of back of the napkin numbers are close and they're what you think. The same way as when you're rehabbing properties, you want to make sure your numbers are close. You want to make sure your numbers and when you go invest in that from the tax savings are close, right? So trap number 2, watch for those properties with high land values. And trap number 3 is what I don't love the saying, but it's what they call don't let the tax tail wag the dog. Basically means don't get into things just for the tax savings of them. You will make bad investments. You need to get into smart investments here. So that Airbnb, that short term, it has to be a good property. It has to cash flow. It has to make sense. It's got to be in a spot where you think this is going to appreciate in value. It's got to be a good overall property, not just one where you're like, I can get a ton of tax savings off of this, because like I said, tax savings is great year 1, year 2, but if you've got a $500,000 property that you're paying off and $40,000 was your tax savings, well, it's not going to be great. You need an asset that's going to generate you income, that's going to produce income, it's going to appreciate in value. Like you want to meet all those other types of qualifications. It's going to rent out, right? It's going to do all those things. So those kind of 3 traps that I see is the 14-day personal use, avoid that, watch for land values, and make smart investments on this. Don't just go for the tax savings. You want to get into properties where it's smart investments, good short-term rental type properties. You have a strategy for what it's going to do after year 1, not just year 1, long-term thinking on these. And you know that you can kind of get property number 2 and start to make money and build them up that way as well. So know that, have a plan for how you're going to do it, how you're going to manage it, and you avoid these traps. Be sure to catch the last video here in the short-term rental series on audit proofing. Probably my personal favorite as the accountant, but I think it will be, whether you find it entertaining or not, it is needed. So make sure you catch that last one on audit proofing your short-term rental.